In this video, we'll continue with adjusting entries and we'll do the last type of adjusting entry, which is unearned revenue. This is a deferred revenue as opposed to a deferred expense, right? Because here we're not paying for something ahead of time and then getting that service later. We're actually getting paid first and we're going to provide services later. All right, so ABC Company received $15,000 for work to be done in the future. So what did ABC Company receive? ABC Company received $15,000 in cash, right? So let's go here. So here we have cash is going up, so that's a debit. We're going to debit cash for that amount, right? And then what did ABC Company give? ABC Company didn't give anything. They gave a promise to do work later, and there's an account for that. It's called unearned revenue. It's a liability, right? So unearned revenue is a liability, so that is going to be our credit. So here we have 15. So cash, I'm going to put in 15,000 for cash. Okay, that is my debit. And I'm going to put in 15,000 here on the credit side. That is my credit. Okay, so now I have cash of 25,000 because again, this 10,000, I give you that number. That's our starting cash. So we added 15 to it. And then we have a credit to unearned revenue. Unearned revenue is a liability. It represents you don't owe money to the customer. You owe services or goods to the customer. So now on January 31st, you check with the folks working on a project and they completed $8,000 worth of work, right? So they provided $8,000 worth of services. So one of the things you have to think about is just think about this conceptually. Okay, here, this represents $15,000, represents work that we need to perform. We need to perform an unearned revenue of $15,000 worth of work. Well, on January 31st, we already did $8,000 worth of work. So $15,000 is the wrong number, right? This needs to be $15,000 less 8. So the balance in unearned revenue needs to go down by the amount of work we perform. So unearned revenue is a liability, right? It's a liability. How do we decrease a liability? We decrease it with a debit. So here I am going to debit unearned revenue for $8,000. Again, why is that? Because if we look at this, this is 15,000. That's what I started with on January 1st when no work was done. Unearned revenue represents the amount of work that I need to perform. Well, I don't need to perform $15,000 worth of work because I did 8, right? I need to perform $15,000 less 8. So this balance needs to change or go down by $8,000. Well, unearned revenue is a liability. How do I decrease it? I debit it. So I'm going to debit this account for 8,000. Okay, to bring it down. So here, my unearned revenue is debited for $8,000. Well, what is my credit? Well, what did I do? I did work. I performed services. Whenever you perform services, you credit revenue, right? That is a revenue account. Here is revenues. How do you increase revenues? With a credit. So I go to my revenue section and I put in 8,000. Okay, and here is my credit for $8,000. Okay, on February 15th, it says ABC completed $3,000 worth of more work. Then I do the exact same thing. I debit unearned revenue for $3,000 and I credit revenue for $3,000. So here's look at what's happening, right? The liability, when the liability is performed, when we owe a liability and we perform that liability or we perform the work that's owed, it becomes revenue. All right. So when we actually do the work that we're promised to do, the liability goes down and that liability becomes revenue in the case of unearned revenue. Right. So we decrease the liability and then we credit the revenue and increase the revenue. OK, so that's pretty much it for unearned revenue. Right. The initial entry and then we have the item. One thing I want to say about journal entries. Right. So here in deferrals, we have an original entry and adjusting entry. The original entry is not the adjusting entry. The adjusting entry is what happens after the original entry. So you'll hear two rules about adjusting entries. One, adjusting entries never involve cash, and you're increasing a revenue account or increasing an expense account. So what's happening in deferrals, right? This original entry, it's not an adjusting entry because it involves cash, and adjusting entries never involve cash. So the adjusting entries is what happens after you receive the payment. So these are your adjusting entries. The original entries are just the entries that takes place during the transaction. Okay. So now we've gone through all the deferral entries and we move on now to accruals.